This is Nightly Business Report with Tyler Matheson and Sue Herrera.
The Fed's dilemma: consumers now pay less for a lot of things. And that makes the central bank's decision on when to hike interest rates a lot more complicated. Steve Leisman reports.
Aftershock, the surprise surge in the Swiss franc is still reverberating around the world. And today, it brought one brokerage firm to its knees.
And taking control, our market monitor guest says this is not the year for passive investing. And he has a list of stocks he says are worth owning. All that and more tonight on Nightly Business Report for Friday, January 16th.
Good evening, everyone, and welcome. It is Friday, and for many of us, the start of a three-day weekend. And after a week of whipsaw moves in the market and a disappointing start to the new earnings season, this weekend couldn't arrive soon enough. But today was different. Stocks snapped a five-day losing streak. By the close, the Dow was up 190 points, the Nasdaq shot up 63, and the S&P added 26, closing back above the 2,000 mark. Today's gains, however, were not enough to overcome a string of losses this week, with each of the major averages down more than 1%. And that steep plunge in oil prices we've been telling you about for a while now, well, they helped send consumer prices sharply lower in December, down 0.4%, the largest drop in nearly 6 years, evidence of falling inflation pressures. So what could the return of market volatility, low oil prices, and no inflation pressure mean for the Federal Reserve and its timetable for raising rates? Steve Leisman has more.
The nation's inflation rate fell to the lowest level in more than 5 years, propelled by crashing oil prices. That was expected. What's more interesting is that when you take out food and energy, the so-called core index, inflation still fell, and that presents a challenge to the Federal Reserve. Headline inflation falling 0.4%, making a year-on-year change of just 0.8%. The core rate was unchanged on the month, and the year-over-year rate a low 1.6%. Gasoline prices plunged 9.4%, and airfares also fell 5%, according to the report. Apparel, apparently there were some sweater discounts over Christmas, falling 1.2%, but prescription drugs rising nearly a percentage point. The Fed is watching the core rate very closely, looking beyond the oil price decline for signs of whether inflation is moving further away from its 2% target, a target it hasn't hit in about 2 years. The puzzle is that unemployment has fallen, and yet there is no sign of inflation. In fact, low bond yields are a sign that the market sees little or no inflation on the horizon. Wage gains have been muted as well, even falling in December. And there are concerns that overseas economic weakness and outright deflation could end up affecting the United States.
We can't keep the rest of the world afloat. The rest of the world is probably what's going to bring us down.
Unless there's some sign that inflation is moving towards the Fed's 2% target, or that wage gains are accelerating, the Fed could put off rate hikes planned for this year.
The Fed is going to pull the trigger when you start to see wage increases. If things continue to slow, they're not going to hire. And if they're not going to hire, wages aren't going to go up. And if wages aren't going to go up, the Fed is going to be on hold longer than people think.
Meanwhile, consumer confidence soared, in part because of the inflation numbers, so there is an upside to these lower price increases.
Low inflation is terrific for consumers, and now we're getting a free stimulus plan called a 50% plunge in oil prices.
And one more bit of news. The Social Security Administration waits for the December number to calculate the cost of living increase for 2015. The 64 million Americans who receive benefits will get a 1.7% hike because of the CPI, and that's equal to last year's rate. For Nightly Business Report, I'm Steve Leisman.
Well, the stock and currency markets are still grappling with Thursday's surprise move, some would say shocking move, by the Swiss National Bank to unhinge its currency from the euro ahead of an expected massive monetary easing plan for the eurozone. And the impact for some companies has been devastating. Sarah Eisen has more now.
Markets and companies are still reeling from the Swiss shocker. Among those feeling the fallout most acutely, non-bank foreign exchange brokers, companies that let retail traders buy and sell currencies. FXCM is the largest in the United States. It said due to the unprecedented volatility in euro-franc pairs, the broker incurred massive losses for clients that owed FXCM about $225 million. Later in the day, financial firm Leucadia announced it's injecting $300 million to rescue FXCM. The firm's regulator is the CFTC, who says it's reviewing the matter. But former CFTC Commissioner Bart Chilton says these retail FX platforms can be a risky business.
There is not an insurance fund like there is for stocks for futures. So these guys could ultimately, and I sure hope this doesn't happen, could be left high and dry because no insurance fund exists for futures positions.
Other firms like Interactive Brokers traded lower on the session as well. That's because many Forex traders didn't consider yesterday's policy reversal from the Swiss National Bank, or SNB, as a real possibility. But the CEO of Gain Capital, a competitor to FXCM, says the warning signs were there.
This was way out on the probability curve. But as I said, they were actually, this SNB was developing a pressure situation that people paying attention to it saw that there was a chance for it to happen. Not when and not likely, but not zero.
The topic even came up during Goldman Sachs' earnings call this morning, where CFO Harvey Schwartz called the currency move, quote, pretty extraordinary, though he did say it wasn't material to Goldman's financials. The bottom line here is that while the retail foreign exchange market may be a tiny piece of this $5 trillion a day currency trading, it could be the first shoe to drop. For Nightly Business Report, I'm Sarah Eisen.
Well, some of the world's biggest banks also reportedly took some big hits after Switzerland removed its cap on the euro. According to reports, Citigroup and Germany's Deutsche Bank both lost upwards of $150 million in the currency markets in one day.
Mohamed ElErian joins us now to talk more about the fallout from Thursday's surprise move by the Swiss National Bank and the implications for the global economy. He is the chief economic advisor at Allianz. Mohamed, it's great to see you again. Welcome back.
Thank you.
Let's talk a little bit about the ripple effects and the implications of this. You maintain in a piece that you penned today that they are pretty far-reaching. Tell us about that.
Yeah, I mean, you have the direct impact, and we heard about it. It's mainly on FX brokers, and it's also on Swiss exporters. This is devastating for Swiss exporters. And remember, Switzerland exports up to 50% to Europe, so that's a huge hit. But it also speaks fundamentally to two other things that are relevant for the global economy. And the first one is the return of volatility in a big way. We are exiting the world of low volatility and entering a world that is going to be much more volatility ahead. And that's important in terms of economic consequences. And the second issue, even more fundamental, is the extent to which central banks are diverting from each other, doing different things. And the exchange market, the foreign exchange market, cannot be the sole shock absorber because you get accidents. So I think this is a fundamental move. It highlights what's ahead in terms of volatility, and it will have an economic impact on the global economy.
Mohamed, you wrote this morning that large currency moves tend to break things. You just mentioned one thing that they may tend to break in this case, and that is Swiss exporters. What else could be broken here?
So what I worry about most is it breaks this notion that we are in a Goldilocks world. It breaks the notion that everything is fine, central banks are going to be predictable, markets are going to be low volatility, so people are going to be willing to take more risk, that somehow we shake this paradigm of low volatility Goldilocks economy, and the result of that is that people become more risk averse. That's my major concern.
Has the Swiss central bank lost, I guess, credibility, for lack of a better word? It used to be the most transparent central bank on the planet, very predictable, very measured, and this shocked the world, certainly. What do you think about that criticism?
So I think it's correct. I myself am puzzled. Why didn't they wait for the weekend? Normally, central banks wait for the weekend. You have to communicate such a move. You have to be able to interact with your financial institutions, with other central banks. Why did they do it on Thursday in the middle of a trading day? That, for me, is a huge puzzle. I actually put it out on Twitter and got some pretty interesting responses as to the possibility. So I do think they mishandled it.
What did the Twitter sphere say to you, Mohamed?
What
were those interesting responses?
So I got a whole range. I got from those who said that they wanted to get ahead of the ECB decision next week, and they wanted to get ahead of other central banks. I got others that said once they took the decision, they were afraid of leaks. I got a third view that they want to discourage further speculation in future. And then I got something that made me laugh a lot, saying, hey, there's Davos coming up in terms of meeting, and maybe the S&B wanted to concentrate on Davos preparation over the weekend. But it is strange that they moved on a Thursday in the middle of the trading day.
What is the chance that the ECB disappoints? There is such high expectations that they will do a massive easing in some way, shape, or form. It's already a very crowded trade out there, and there is the chance that they could disappoint. What happens then, if that happens?
So if they don't deliver at least $500 billion in terms of a new program, and if they don't deliver a pretty clean loss-sharing mechanism, so if they disappoint on these issues, then you will see a sell-off in markets. The market has priced in a significant ECB QE. And if the market doesn't get that, then it will sell off.
Mohamed, thank you so much for joining us. We appreciate it. Mohamed ElErian with Allianz. Ty?
Well, back to oil prices now, which closed higher, get this, for the first time in 8 weeks after the International Energy Agency said there were signs that lower prices finally have prompted some producers to cut output and that, quote, the tide will turn on tumbling prices. Domestic crude up $2.50 a barrel, $48.69 the close. Benchmark Brent up $1.90, settling at just over $50 a barrel.
The steady decline in oil prices is now prompting some energy companies to scale back, not only on production, but also on their workforce. Morgan Brennan has more.
The job losses are beginning to mount as oil's price collapse wreaks havoc on the energy sector. The latest and one of the biggest examples so far, Schlumberger. The oilfield services company reported better than expected earnings this week, but still cut 9,000 positions in the fourth quarter, a 7% reduction of its global workforce. And given the challenging year ahead, warned that more could be in store. Analysts think the worst has yet to come for the entire sector.
I'd expect more pretty much across the board from the big companies down to the smallest. With E&P capital expenditures likely to come down in the U.S. 30–35% over the course of this year, there will be job losses. You're seeing announcements out of the big producers as well, Apache and others.
Apache said it would eliminate 250 jobs, 5% of its workforce, this week. Shell, Suncor, BP, EOG Resources, and Enbridge have all recently announced layoffs as well. Schlumberger's competitor Halliburton also cut 1,000 positions, with more potentially in the works, something to watch for in its earnings next week. And some investors think it will get much uglier for oil majors that spend billions of dollars on long-term projects.
The fracking and shale revolution was propelling us to be the largest oil producer. And in a way that I thought was uneconomic, and still is uneconomic for the drillers, but it was going to be enough supply to really disrupt the markets. More importantly, the big oil companies, the Exxons, Royal Dutches, and the Petrobras's, and are finding their business model challenged because the days of finding easy, cheap oil is over.
The Dallas Federal Reserve Bank estimates 140,000 jobs could be lost this year in Texas alone, including industries indirectly tied to energy like construction. And that, too, is beginning to materialize, with U.S. Steel laying off 750 workers and idling 2 plants that make drilling products, including one in the Lone Star State. For a Nightly Business Report, I'm Morgan Brennan.
And still ahead, when an index fund isn't enough, our Market Monitor guest has a list of individual stocks that may be worth some cash.
A potentially historic ruling may be on the way for gay marriage. The U.S. Supreme Court, the highest court in the land, announced today that it will decide whether same-sex couples have the constitutional right to marry everywhere in the U.S. Cases for and against will be argued in April, and a decision expected by late June. Many companies already recognize same-sex marriage when it comes to health care and other benefits.
Marilyn Tavenner, the Medicare chief and Obama administration official who largely oversaw the rocky rollout of the Affordable Care Act, announced that she is stepping down in the next month. Although she is credited with helping millions of Americans get health insurance for the first time, she joins HHS Secretary Kathleen Sebelius as the second key administration official to resign in the wake of the botched rollout of the federal health care marketplaces.
President Obama and British Prime Minister David Cameron both urging patience over negotiations with Iran and Russia at a White House news conference today. President Obama stressing diplomacy, and he vows to veto proposed bipartisan legislation to impose new sanctions on Iran.
We agree that the international community needs to remain united as we seek a comprehensive diplomatic solution to prevent Iran from obtaining a nuclear weapon. And I'd add that additional sanctions on Iran at this time would undermine that international unity and set back our chances for a diplomatic solution.
Both leaders took a harder line on Russia, expressing continued support for Ukraine and continued pressure on Moscow.
We begin Market Focus tonight with a slew of bank earnings. That's a lot, a slew. First, Goldman Sachs out with numbers today. The results topped estimates, but the firm did report a 7% year-to-year drop in fourth quarter profit. It cited weak fixed income trading as the main reason for the decline there. Shares off slightly today to 177.23. Next, PNC Financial. It said that its profit and revenue slid. Despite that, its quarterlies were better than expected as the strengthening economy bolstered its commercial lending, and the company set aside less money to cover loan losses. Shares up $2. It finished at $84.44. Charles Schwab saw its fourth quarter profit pop by almost 10% as revenue and net income growth set new records. The company said that despite low interest rates, it was able to deliver some of its strongest results in history. Shares there up slightly to $26.90. SunTrust Bank's earnings fell because of a mortgage-related legal expense. Despite that, the lender's adjusted profit beat estimates as loans grew in the fourth quarter. Shares up 4% to $38.19.
Shares of Precision Cast Parts, she tried to say, slumped after it issued a weak outlook. The metals, components, and products maker said that its third quarter results would be lower than expected, citing falling sales in the oil and gas industry. Canaccord Genuity also downgraded that stock to hold from buy. The shares tumbled 9% to $199.63. Amazon is being investigated by European regulators because of its tax arrangement in Luxembourg. The European Union says that the deal the retailer made appears to have resulted in unfair state aid that may have allowed that company to underpay its taxes for a decade. Shares, nonetheless, were up 1% to $290.74. And shares of Activision rallied today on news that its Call of Duty Advanced Warfare was the top-selling console game last year. That makes it the top-selling U.S. franchise for the 6th year in a row, while its Skylanders Trap Team was the #1 video game for kids globally. Shares spiked 9% to $20.25.
Our market monitor tonight says this year in an index fund just won't be sufficient. He's John Traynor, Chief Investment Officer at People's United Bank's $5.5 billion wealth management division. Welcome. Good to have you with us, John. Why do you think this year particularly is a year when indexes will underperform, or are you better off with a stock picker?
Well, first of all, we would agree with your prior guest, Mohamed ElErian. We believe we're going to see volatility increase this year, which will be good for active managers. But that we would take that even further and say the divergence that you're going to see, the divergence between the U.S. and Europe, the divergence between the Fed and the ECB and the Bank of Japan, and even the divergence between the oil winners and losers here in our own economy and around the world, that divergence between the good and the bad will create opportunities for active money managers. So we think the opportunity set will increase this year. So active management should do very well this year.
But how important is it for the individual investor to really know what is in that portfolio and know how it's weighted?
That's critical, and I'll give you an example. When you take a look at the emerging markets, you can buy an emerging market ETF, which can be very good. We're not against ETFs, but if you take a look at that, we believe there would be a big divergence this year between the commodity-oriented emerging market countries and the commodity-consuming emerging market countries. So we would suggest that you would take a look at the mutual fund that you own and err toward emerging Asia and away from Latin America, away from some of the commodity-oriented countries. So understand how your portfolio is weighted is very critical.
All right, John, let's get to a couple of your stock picks, and they are U.S. stocks, beginning with one of the big mega caps in tech, Oracle. Why do you like it?
We like Oracle. If you think about the headlines last year, the data breaches that we saw for large companies, for the government, and even Twitter feeds and some of the social networks, that was all about data security. Oracle is the leading company in database management. They were a little slow to get to the cloud. We think they're catching up. They're making the right moves. But database security is going to be critical going forward, and Oracle is the leader in that industry.
You also like Express Scripts because of their efficiencies.
We like their efficiencies, and one of the things we're looking at, as your viewers know, there's a very important Supreme Court decision that will come out later on this year that'll determine whether or not the state exchanges can continue functioning. We're looking for companies that will do well, whether the Supreme Court rules in either direction. Express Scripts brings cost control to the industry. We like it no matter however the Supreme Court rules.
And your third choice is a stock that was really beaten down over the past couple of years. It's come back a good bit. Why do you like it at this price, and how high do you think it can go? And that is Whole Foods.
Whole Foods is a company that we liked for quite a while. We liked the story, we liked the management, but it was just too expensive for us. We started looking at this back in early 2013. The stock traded off. It really came down last summer. We took another look at it, and we actually added it to our portfolios in September at about 39. The key issue here is they lost track of their value proposition. And what the company did was they focused on good food at good prices. They had great earnings. They really surprised us in their November earnings report. And we think that business model is back on track, and we're positive on Whole Foods.
Very quickly, your comments on the economy. How does it feel to you, John? Because there's some talk of deflation out there, which could be worrisome for the stock market as well.
We don't think you're going to see deflation, actually inflation declining, but low inflation in the U.S. And again, one of your prior guests talked about wage inflation. We think that's the key. That's what we're focusing on. We don't think that you're going to see the Fed really make a move on interest rates until they see wage inflation, and that's good for the economy and that's good for the stock market.
John, thank you very much. Have a great weekend.
Thank you.
John Trainer with People's United Wealth Management.
You got to see this to believe it. Coming up, the big jump in demand for very small houses and the prices that people are willing to pay.
Dow Component AT&T says it will take a $10 billion charge in the fourth quarter. The company says the charge is related in part to pension and post-employment benefit plans. AT&T says the charge will not impact its operating results.
Despite the 6-month standoff between West Coast dock workers and their employers, the Port of Los Angeles just reported its busiest year since 2007. Container volume at the port, the second busiest on the West Coast after the nearby port of Long Beach, saw container volume rise 6% in 2014. And just today, in an effort to end the standoff between the port and their dock workers, 174 industry groups sent a letter to both sides telling them to, quote, get it done.
Well, good news about investing in new businesses. A new report led by PricewaterhouseCoopers says that U.S. venture capitalists invested more than $48 billion in enterprises last year, and that was the most since the year 2000, around the time of the dot-com boom.
And finally tonight, you know they say that good things come in small packages. Well, when it comes to real estate in Silicon Valley, small homes, and I mean really small, are coming with some gigantic price tags. Josh Lipton has the story.
In the heart of Silicon Valley, there's been a big jump in the price of small homes. Palo Alto is one of the most sought-after communities in the Bay Area, with its elegant downtown, respected schools, and proximity to the headquarters of tech giants such as Facebook and Google. In fact, demand is so strong in Palo Alto and inventory so lean that homes that look more like bungalows are now selling for millions. For example, there's this home at 151 Kellogg. It's a 2-bedroom, 1-bath, only about 990 square feet, and it just sold for $3 million. That's not unusual. In 2014, the median price of a home in Palo Alto with less than 1,000 square feet of living space surged 40% to $1.7 million, according to DeLeon Realty, a realtor in Palo Alto. Realtors say a lot of the move can be explained by the flow of new tech money in the area driving prices higher, as well as an influx of international investors looking to capitalize on a red-hot real estate market.
About 40% of these buyers would be investors from overseas. Particularly, the Chinese really want brand new homes, so they're buying these small homes with larger lots, tearing them down, and then building up their dream home.
Of course, such a surge in home prices brings up the question of whether there's a housing bubble developing in Palo Alto. Economists don't think so. They say the big jump in income growth will keep supporting home prices in the area, at least in the near term. For Nightly Business Report, I'm Josh Lipton in Silicon Valley.
Makes New York City look cheap.
Whoa, I'm feeling blessed here. My goodness.
Absolutely.
You're a California girl. You're used to it, I guess.
Not that.
Not that.
Not quite that. All right. That does it for Nightly Business Report for tonight. I'm Sue Herrera. Thanks for watching.
And thanks for me as well. I'm Tyler Matheson. Have a great long weekend, everybody. We'll see you Monday.